Bloomberg News.
We are at the beginning of the worst economic contractions since the Great Depression. Those are the words of Marc Faber. He's managing director of Marc Faber Limited and publisher of the Gloom, Boom and Doom report. He joins us from Zurich to discuss his 2009 outlook and investment strategy based on the global economic turmoil. Mark, thank you very much indeed for joining us. Right, you say,
pleasure.
Yep, the US has been in recession since 2007. How much worse is it going to get
October,
then?
Yes. Well, I think we are faced with a global recession that will last a very long time. I mean, I think recovery will not come for the next couple of years, maybe in 5-10 years' time. But I really don't see a catalyst that would propel economic growth to a higher rate. I think we'll fall sharply like we fell in economic activity in October, November, early December, and will be at the bottom of the valley for quite some time, and maybe we'll go even lower. I think 2009 is going to be a catastrophe, economically speaking.
Right. I'm not going to get to the market implications for the time being, but I just want to get your view as to the policies, the monetary policies in particular enacted by governments around the world. You say it's not enough. What do they need to do then?
What I mean is that the monetary policies that have been pursued by the US in particular over the last 10 years or so, that they are actually responsible for the economic imbalances that we have experienced and that have now led to the financial crisis. I give you just a very simple example. Had LTCM not been bailed out in 1998, we wouldn't have the colossal leverage in the system we have today because market participants would have been much more careful. And so these bailouts have actually led to huge excesses and leverage and excessive debt growth. That brought about the crisis when debt growth slowed down.
But surely the Fed and the Treasury could have just sat back and done nothing.
That would have been by far the better option, not to do anything. Let Mexico go bankrupt in 1994, let LTCM go bankrupt in 1994, and certainly after 2001, not to cut interest rates as aggressively as they've done, and then let them on the Fed fund rate at 1% until June 2004, when in fact the economic recovery in America began in November 2001. So almost 3 years into an economic expansion, you have Fed fund rates at 1%. And what people misunderstand is that in a system you have savers. And when the savers don't get any interest on the bank deposits, they go and do stupid things. They invest in all kinds of speculative activities because it's actually the Fed that forces them to do that because the interest rates are below the rate of inflation.
So what does this also mean for, let's say, various central banks who have been printing money, the so-called quantitative easing as well? What are the risks coming from that?
Well, I tell you what the risk is, in my opinion. It is hard to believe that after having blown up so many bubbles over the last couple of years, the Fed managed to blow yet another bubble, and this is the Treasury bond bubble. If you look at the 30-year Treasury bonds in the United States, they're yielding now, say, 2.5%. You would have to assume for the next 30 years that inflation is not the problem. And the way I see it, with their quantitative easing and their expansionary fiscal and monetary policies, there will be in future a time when the rate of inflation will accelerate, probably as a result of very weak currencies, the dollar in particular. And when that happens, the central bank would then have to increase interest rates above the rate of inflation and above nominal GDP growth. And that will be very difficult to implement, in my opinion.
Mark, you know, the thing is, you're predicting a severe contraction looking ahead next year. You know, do you think markets have already factored that in?
Well, basically, we became very oversold on November 21st of this year, and then we had a rebound of essentially 20% on the S&P. And I think markets may rebound somewhat more. But after that rebound, I think that markets will drift again lower because the valuations are not that compelling. They are, say, compelling compared to treasury bill yields that are zero, but they're not compelling on a PE basis or on dividend yields or on book values. And I think that corporate earnings will go down and then stay depressed for quite some time. If you talk about valuations that are inexpensive, I would imagine that commodity prices now, after this huge setback since July 2008, that commodities are relatively low, and also the Asian markets, because Japan is now at about the same level in 1981. South Korea is at the same level it was in 1988. And I can assure you in Asia we had a lot of progress over that time. So in Asia stocks are probably okay, but they can still go down somewhat more because the economy in Asia will be affected very badly by the global recession.
Now, you're avoiding China at the moment. Why is that?
Well, I think that the Chinese equities market can rebound. We went down from essentially a peak of 6,000 to around 2,000, and we can easily go up 30%. And by the way, a lot of stocks from their lows have already rebounded 30–40%. So we are in a very volatile environment, and I think I prefer not to make any predictions for year-end 2009, because in between we could have swings of 30–40%, and in individual stocks of 100%. Newmont Mining, as an example, went down to $21, and 10 days later it's at $40. So we have these huge swings, and it's less about investing than about trading at the present time.
What is, where are we with the China story then, Mark?
Well, I think that the Chinese economy will suffer very badly. They'll have a bad recession. And I also think that politically in the world, geopolitically, we have tensions coming up. And so I would be trading Chinese stocks. Maybe you buy them here and you resell them like other emerging economy stock markets that have underperformed the US over the last 14 months. Since the market peak for 2007, the emerging markets and also commodities have been hammered. And so the rebound may occur there more than, say, in the United States.
Mark,
but I would, as I said, look at it as a trading opportunity.
Mark, very quickly as well, where are you investing? Where, just very quickly, which industries, which countries?
Well, I continue to like gold, and at the present time, what is very depressed compared to physical gold are gold miners, the exploration companies. I would also say that oil at around this level is becoming attractive, and that oil companies are reasonably attractive. So these are the investments I would carry out at the present time. And then the big mining companies, CVRD, Rio Tinto, BHP, and larger gold-producing companies like Newmont. But after their very strong rebound,
Mark,
I think we have to wait for a correction.
Well, the thing is, are you surprised you got away with it for so long, and what needs to be done about this?
Well, not really, because the U.S. government is still getting away with it, and it's also a Ponzi scheme whereby people are being paid by the government by issuing securities, and the whole system will break down one day, and it will be much bigger than Madoff.
Right, so in order to stop that, I mean, you must be looking at some important changes, or are you, in terms of how these things are regulated?
Well, I think, first of all, it's important to note that the majority of investors in Madoff were actually funds of funds. Now, the funds of funds, they go to people like you and me, and they tell us, well, we will select the managers because we know how to do the due diligence and to select managers carefully. But they didn't do their due diligence, because I go and also visit hedge funds. And if you go, say, to Bridgewater or to Paul Tudor Jones or Louis Bacon, they have a big organization with hundreds of people working for them. And it's unlikely that when 100 people work in an organization, that all could be fraudulent and that they could just misappropriate funds. And they have decent auditors and accountants and so forth. But the SEC really fell asleep over Madoff, and they never checked anything.